Thank you, Mr. Chairman, and thank you to the witnesses for being here. And I want to follow up on something that the chairman of the subcommittee asked before he left. And I'd like all the witnesses to sort of go down and give me their view of this issue. I believe that a floating net asset value will actually exacerbate the problem because it will encourage people to redeem as soon as possible because the risk is that your money will be worth less tomorrow or 5 minutes from now or whatever. So I guess I want to ask all the way down the panel what your view is on that. I believe it makes the problem worse, not better, as far as rush to redemption. Could each witness tell me their opinion on whether they think it makes the problem better or worse?
We believe it would make the problem worse. That as institutional investors, we're very concerned about it would make the problem worse. We also believe that the nuances of daily pricing, it will create some problems and confusion in the marketplace. It does not give time for any pricing errors to be reconciled and mitigated before damages are done. And so we do think there are a lot of issues. We think it would make the problem worse.
Thank you.
A floating NAV would make the problem, it deals with the core problem, which is that with a stable NAV, if the fund's only worth 97 cents, you can pull out at $1. You're given an affirmative incentive to run. Markets reprice all the time, but if you get with a floating NAV, if you get out, you have to take a loss.
We do think a floating NAV will increase the transparency. Schwab voluntarily chose to disclose our shadow NAVs earlier this year, so we do think that that helps transparency and reduces the surprise factor. So if there is a discrepancy between the underlying...
My question is, will it increase the race to redemption? Not, does it increase transparency?
Yep.
Could you answer that question?
Yes, I do think it helps mitigate the run risk.
Okay.
I agree very strongly with you, sir, and also would echo the comments of Mr. McCoy.
We actually saw during the financial crisis funds that had floating net asset values per share experiencing massive redemptions. French money funds that had variable NAVs experienced them. Short-term bond funds in the United States experienced them. And more generally, we think that what happened with the reserve primary fund was not attributable to its breaking a buck. It was a flight to quality. It was a flight to treasuries and other quality instruments that was characteristic of the broad market. Two-thirds of all the dollars that flowed out of U.S. prime funds during that period flowed into Treasury and government agency funds. So I don't think it was a fear of the breaking the buck. It was a general preference for safer assets. And if the reserve primary fund had been floating at the time, you still would have found that effect.
Thank you. Ms. Baer, if the floating net asset value results in a massive change in the size of the money market mutual funds market, which it probably will, from say $3 trillion to $1 trillion, and $2 trillion flows into banks that are government insured with a government guarantee, doesn't that exacerbate the too big to fail problem we have?
Well, I think, you know, the deposit limit's $250,000, so those are going to be uninsured deposits, and I don't know if that's where it's going to go. I am skeptical of industry, some industry, not everyone, some industry predictions that this is going to result in a massive downsizing of the money fund industry. There will be some downsizing.
But there is a government guarantee up to $250,000.
And there's also, but banks, unlike, banks aren't perfect, and I'm not singling out money funds. There are a lot of reforms I'd like to see with banks. But deposits, we did not have a systemic problem with deposits. Deposits did not run. Because we have a whole elaborate system of deposit insurance, of access to Federal Reserve lending. Banks have to hold capital and unsecured debt, which by statute take first loss before you even get to deposits. So that part of the banking system worked well.
But it makes the banks bigger if the funds flow to the banks. That's correct, isn't it?
If those deposits flow into banks, yes,
Thank
it will.
you.
Yes.
The next question I have is for the two treasurers, Mr. Gilligan and then the state treasurer, about what would happen, what would you do if you didn't have a stable net asset value in money market mutual funds? Would you be able to use them to invest in? Mr. Treasurer.
For the state of Georgia, that our focus would be, because so many of the local governments cannot invest in privately managed money market funds. They can't invest in the state local government investment pool. if we could not operate as a stable value, we would explore how to operate as a stable value. It may not be a 2A7-like fund, but we could not, under the current state laws, and I don't think it'd be prudent to change our state laws to take away the preservation of principal as a top priority, to actually move to a floating NAV. So we would explore how to restructure local government investment pools, as I think other states would too. I think also, I would like to comment your earlier question is banks. There is also
McCoy.
bank stiff funds. I'm sorry.
The time of the gentleman's expired. Thank you for your answer.